right, everybody, welcome to another episode of the Alternative Investor Mastermind. Today we have a special guest, Bill Bymel of First Lien Capital. I've known Bill many years in the non-performing loan business, and he's got a really great background across real estate, performing, non-performing loans. And Bill, really excited to have you on the show.
Jack, it's great to be with you. As always,
it's great to connect. Look forward to connecting in person at some point in the future.
I know I had a room booked in Vegas the weekend of Paper Source. As a matter of fact, I came to Vegas Friday night of Paper Source, and what ended up happening is I had to get back to California so quickly, and so I decided to just make it a Friday night trip with my 16-year-old, and we went. And by the time we got to town, we got to dinner, we went to see O, and, we just hung out. And I was like, oh, my whole intention was to come to see you in person. And then I just woke up too late and took off.
It's all right. The good news is, I get to Vegas relatively often. So there'll be
That's right. That's right. I can always find you there. Right?
Yeah. But Bill, you've got a pretty awesome story. Why don't you just kind of, if you don't mind, just go through kind of your background and how you got into real estate and just your path, which I think is pretty interesting.
Yeah, no, and not dissimilar. I think one of the ways that you and I connected was there was some similarities in our background. I've been in real estate. This is my 20th year in real estate. I started as a fix and flip residential investor in South Florida. At that time, I was running my own brokerage of a bunch of residential agents. So imagine the early 2000s in Florida. There was a lot of tailwinds, a lot of excitement, and real estate values were on the up and up. And then a few years into that, I became a partner in a commercial real estate firm. This was before the residential market even really had leveled off. I don't know if it was good timing or, just a bit of stroke of luck, but I got into commercial doing new development for retail and restaurant clients, mostly national brand tenants. So I remain a partner today in a company called Retail Sites International based in Fort Lauderdale, 40-year-old brokerage. We've represented household names in the restaurant and retail world, such as Every Darden Concept in South Florida, Red Lobster, Seasons 52, Olive Garden, Bahama Breeze. Now they own Capitol Grill and Yard House. And, Darden's one of the largest casual dining restaurants chains the largest in the world. And we are their exclusive representation. So we help them find their locations, negotiate. Sometimes we get involved in the development. We did that also with other retailers over the years, CVS, Family Dollar, one-off restaurateurs. Well, I was doing all of that from about 2005 to 2009, 2010. There was some overlap with the residential mortgage meltdown and the residential crisis of 2008. It all started with a call I got in the summer of 2008, 3 months before the fall of Lehman Brothers. And I get a call from this guy in Southern California. It was at a small 25-person investment firm called Condor Capital. They were bidding a pool of construction to perm loans in Port St. Lucie, Florida, that were all like first and second payment defaults. And, this was at a time that the residential real estate market, by mid 2008 had gone, was probably 12 months into a stall in sales. And so there was and prices were going down for the first time in decades in residential real estate, and nobody knew where the bottom was. So basically there was the opportunity at the time for me to jump in and get involved in the secondary mortgage market, buying notes at a discount. I did it as an advisor to Condor. I helped, it was a light bulb moment the summer of 2008. And then we all lived through the fall of Lehman Brothers, the possible end of the, major financial crisis, end of American dollar at one point, I think was when the band played, some of the talk then. And by the way, I had an anecdote I would note. Remember all the fighting that went on in DC about this huge spending bill. $700 billion.
It's a rounding
When you
error now.
compare it to today, where it's like 3 trillion, 6 trillion, they just, let's just write another check. We'll come back to that, I'm sure, in conversation. So, that's what I've done for 14 years is my focus in real estate has been buying non-performing, sub-performing residential mortgage loans, mostly first lien position. We've seen, we've focused on first lien because we have institutional partners. We look for what I see as the greatest risk-adjusted return in real estate, because you're buying first lien mortgages, either performing, non-performing, sub-performing, whatever they might be. You're getting them at a discount to their face value. So you're buying the debt at a discount, and that debt usually sits in a protected equity position collateralized by the real estate and first lien. So, from a safety standpoint, I think it's just a great investment. We've done this consistently now. I did it at Spurs Capital for 10 years as a managing director. And then I stepped down from my active role at Spurs about 2 years ago when we thought the Black Swan event had come, this little COVID issue. We thought that was the Black Swan event that would create a mortgage, meltdown or, crisis in financial markets. Obviously, going back to the conversation of $3 trillion, that was delayed a few years. I founded First Lien Capital about a year ago. The focus again on utilizing luckily I have developed these relationships in this secondary mortgage market. That's where I met you, and we did some trades over the years, and we're part of a little old boys network that we got lucky enough to be invited into, and I have access to product to buy either from private equity firms or banks and work those out. So First Lien Capital is in our first year of operation, spent about $30 million buying non-performing, sub-performing debt, mostly tails from our competitors. And we are really well positioned right now to take advantage of any dislocation that happens in secondary markets. And that's like all the talk right now. I mean, with the way that the economy has turned in the last 90 days, the rise in interest rates, the inflation issues, and the war in Ukraine, all of these elements have basically the motto is, if we're not already in a recession, when will we be, and for how long? What will the landing look like? Versus, are we headed into a recession, which was still the conversation, a year ago or 6 months ago. And so the general consensus is that markets are turning, that there will be a lot more distressed product. The other thing that I want to point out is when I say we're a buyer of distressed mortgages. In reality, we look, and especially in these last few years, as we're coming to the end of a long cycle upward, rather than buying distressed real estate or distressed assets, we're looking to buy quality assets or the liens on quality assets with distressed sellers. So, and it's a little bit of a nuanced change from where we were 10 years ago, when you just kind of you were buying everything so cheap that it was like, okay, yeah, I'll buy that crappy house in Tennessee where, you don't know if it's a tear down and maybe land value, but we'll take the good with the bad. Now we've had to be a little bit more selective with what we've been buying. But, that's the long and short of it. I manage a fund that buys distressed real estate, mostly residential.
That's great. Thanks for that. You're really taking me back now, thinking about the kind of 2008 and what things were like there. Let's build on that a little bit. 2008 or 2010, 11, 12, you're almost buying everything cheap at a discount.
Right.
Almost everything was underwater. And,
right.
Although I generally agree with you that we're, probably moving into some type of recession, but I'm going to quote Howard Marks, who was Oak Tree Capital. History may not repeat itself, but it does rhyme. And
yes, exactly.
What do you think about this? Is different than 08 completely.
Yeah, for sure. We're not in a situation. The mortgage market itself is much healthier in general. You don't have millions of Americans that are laden with debt that they should never have had in the first place. You do have some that have overextended. There is no doubt we have the largest amount of debt load when you compare, not just mortgages and secured debt, but when you look at the unsecured debt that's out there, people spending on credit cards and other types of unsecured debt, it is the largest number in history. And a lot of that debt is variable. A lot of that debt is expensive. And if people start to lose their jobs this year because companies go under or downsize, like we are seeing that in the mortgage origination market, obviously. Quicken Loans just laid off 1,000 folks, as an example. But we will see in any recession, you're going to see layoffs, you're going to see companies go under. And so there's another aspect to financial markets. There are other things at play here. And, the mortgage market and the real estate market are not going to be the catalyst for a downturn in the economy, but we're going to be a byproduct of it because real estate is such a huge part of the American and global economy. And so much so that, a part of everyday American sense of net worth, that there will definitely be a side effect to the real estate market. Look, we've seen an increase since COVID in values, 20% in some areas, year over year. So really 40% increases in value. That is not a healthy thing for the real estate market. Real estate is meant to be the slow and steady, safe investment, that you would normally get a nice, decent single-digit return on, whether it's as an investment property or whatnot, and benefit from the huge tax opportunities, tax deferrals and tax advantages to owning real estate. And that really drives your true return into, even in a safe investment into the double digits when you look at the tax savings. So to see the real estate market go as crazy as it's gone the last 2 years, that's the most worrisome part, to be honest. It's not a good thing for real estate to jump at those numbers because now you're coming up against if you look at a year ago, the average median, let's say the median income home was like $350,000 and the average mortgage rate of 4% or 4.25%, let's say, or 4%. So that payment for that median house was a $1,500 a month payment. But those houses, since the run up of the last year, are now $500,000 or $450,000, and interest rates are already at 5.5%, 6%. So now you're talking about a $2,500 a month payment. Most people buy homes in America based on the payment relative to the payment amount. And we do forget, and here's where the world rhymes, right? Here's where history will rhyme a little bit, is how different 2006 and 2007 were in residential real estate. In 2006, the mentality was very much like it was just 3 months ago. Get your hands on whatever you can get. There's five or 10 buyers for every deal out there. The flippers are making more money, and wholesalers are making. You would know, you were a wholesaler. Wholesalers are making more money than the actual fix and flippers. The speculators are fighting against the first-time home buyers, and you hit kind of like an affordability wall at some point, and that's what happened in 2006. And then the music just stopped, and when you look back on it, it actually seems like it just happened overnight. But we're like the frog in the boiling water right now. We're not realizing what's happening. You saw a 25% decrease in new construction home sales year over year last month. So the new home builders are already sounding the alarms. And we could go from, people have keep saying, and even at a conference I was at yesterday, where everyone wants to still paint rosy glasses. Well, we're still 5 million homes short. So from a supply standpoint, there's still way more demand than there is supply. And yes, there's, instead of 5 offers for every one property like in 06, there was actually probably 10 or 15 this last year for every one property on the market. So there's definitely more demand. But the reality and where it rhymes is, you can go from a market that has zero supply, hot as can be, to a market that is oversaturated, plateauing, and maybe on the decline in a period of 12 to 18 months very easily. And so that's kind of where I think we are right now in the market, that there is a general consensus. Like, the facts are proving the market's slowing down. Deals that were selling 20% above list price are now selling at list price. You said it to me earlier. We were talking about this, and this is why I told you we got to get this started, because this conversation came up a lot yesterday amongst these multifamily buyers. So, guys went in 6 months ago and bid, list price, or 98% of list price, or 105% of list price on a multifamily 200 unit deal, only to be told 3-4 months ago that they were outbid by 20%. And now they're getting calls 3 months later from those same sellers to say, well, the 20% buyer is gone. There was 2 other buyers ahead of you. They're gone. Would you like to do the deal?
Yeah.
And so we've seen even in commercial multifamily markets, and in all other asset classes of commercial, a huge brakes being put on this market just in the last 90 days. And it's not even really reflected in the public sentiment. So hopefully your podcast gets out before the news gets out, and so we can take some credit.
I hope so. Yeah, I think the $1 million question on the residential side of the market is, with rates going up, how many people locked in at 30-year fixed versus in 2006?
Correct.
So many people were on these option arms where 3
That's
years later
correct.
the payment went up. And my gut says a fair amount of people that locked in, whether it was through a Fannie Mae, Freddie Mac loan, or some type of non-QM for, the higher end markets that, are over 600, 700,000, that the people that bought, my hope is the bull case is the people that bought right, locked in a low rate, and those houses probably stay off the market as long as they can afford their low payment. The other side of the coin is the people that continue to stretch, that, are in now and are like, well, 5% isn't still too bad. Let me pay $2,500 a month instead of $1,500 a month. And, there's always going to be a level of distress.
Sure. Good. No, absolutely. That's a very good point. And you're right, by the way. Everybody I've been telling to, like, I've been saying this for a year, actually. I've been saying lock in the lowest interest long-term 30-year rate you can find. We will look back on this, Jack, in 10 years, 5 years from now, maybe 20. Hopefully we'll both be still kicking then, which we should be, and we'll say that there will never be a time in this country again that I could imagine where you will be able to get a sub 4% 30-year fixed mortgage. I mean, I remember as a kid, 35 years ago, my dad coming home. This was in the late 70s, early 80s, obviously the exact opposite end of the interest rate spectrum. But, it was the early 80s, and my dad came home with a FHA mortgage. We were moving to the other side of the tracks into a big 4-bedroom where I got to have my own bathroom, and it was so exciting. And he came home and he was dancing. So, oh, we got approved. I mean, you won't believe the interest rate, 11.25%. Oh my God. But that's the reality. I mean, I think that we'll certainly, we could see interest rates go pretty deep. I don't think we'll see the 30-year fix get into the double digits, but I it's normal to think that, 6%, 7% interest rates on a 30-year fixed loan is a reasonable rate. So hopefully those people did lock in, and there was a lot more of that going on. And to your second point, Jack, there's always a distressed market. There's always some distressed situation. People die, people get divorced. Like you said, people overextend. They take out second mortgages and HELOCs, and all of a sudden they're upside down and they lose their job. There are any number of situations in any market historically where, there's always distress. So when you look at the residential real estate market, and this is what I am constantly being asked by our potential investors, whether they're private investors or institutional partners, well, where's the product? How do you have the product? Do you have the access to supply? Happens to be one of the areas that we've really gotten good at, is getting access to product that's, some negotiated trades off market kind of stuff. But what I say to them is listen, if I'm going to deploy $100 million or $200 million, that might sound like a lot of money to you, me, and the average person. But in the mortgage world, that's like a piece of salt. That is like a speck. $100 million buys us maybe 100 mortgages or 200, 300 mortgages, and there are millions of mortgages. So when you look at the $12 trillion residential real estate market, even at its best case scenario, and we're at the lowest default rates in history right now, as to be expected, we're just coming off of cheap money and huge rises in value. So at our lowest rates of default in America, you're maybe 2% or something like that. That means there's 250 billion with a B of debt that's going through some sort of distress at any given moment. So now do you want to be an investor, and spend 100 million, even $1 billion? Think about even being $1 billion investor in the mortgage market. There's 250 times that on the best case scenario. Now imagine where we're going to go right now. We know for a fact that there's still about 1 million loans, somewhere between 800,000 and 1 million loans that were the worst of the worst forbearance loans. People that lost their jobs, stopped paying their mortgage because of a COVID shutdown. About 5 million Americans went through the program. 4 million exited successfully through, some sort of resolution, either to get back on track or sell the property. But we know for a fact that there still sits 800,000 to 1 million loans. That number alone will double the size of our current default market overnight once those start to really come out of the system. And anecdotally, I can tell you some of the major servicers that we met with in March in Palm Beach. They're telling us we got 35,000 loans that have already been defaulted. The notice has been sent, and the bank's telling us not to start the foreclosure. I had another servicer say, we got about 50,000 loans queued up, ready to go into foreclosure. Our major bank clients haven't been one. Nobody's wanted to be the first one to pull the trigger. So now that the world reality is setting in, I think we're going to start to see a lot of that come out, because, nobody really, the markets have changed. The paradigm is shifting. And thank God, markets are cyclical. We need this. It's for the health of the long-term. Long-term real estate's the best investment you can be in. But, it's not going to continue to go up 20% per year. As a matter of fact, you don't want to be the guy that bought last year, and if you are, hopefully you had enough equity in the deal, or that you can cover with a fixed payment plan, or you cover your rent payments, whatever it might be, and you're good, and you can ride out the coming storm, because there is going to have to be a reset in certain markets.
Absolutely. So curious what your thoughts, mentioning kind of, coming out of COVID here. I mean, some of the population shifts were pretty incredible during COVID, both just, and I think some of that had to do with just being able to work remotely.
Yeah.
And, I got to bust your chops for this. I think you're the only person I know who moved into California and raised your taxes versus moved to Florida or Nevada.
You went so far as to go to the least tax situation. You went to an island in the middle of the Caribbean just to avoid taxes.
Yeah, but
I mean,
yeah,
I
I'm
guess there's
curious.
other benefits, right?
Yeah, oh yeah, it's great. I live a block from the beach, and
Yeah,
save tax. It's a much better lifestyle. The New York grind can wear on you after a while. Though I'd love
for
New York.
sure.
Love to have a second home or a pied a terre there. But when
Oh,
you're
and
looking at
hopefully the
markets,
markets will cycle and we can buy ourselves some condos in New York. I'm dying to see California, take a turn for reality because when I look back at 2014 years ago, I could have bought houses in my neighborhood. Now I'm in Beverly Hills, and the upper flats. There's houses that were 2-3 million bucks back in 2010 that are 23 million now. I mean, it's just insane. And so obviously I'm not going to buy at 23 million, but I'm looking forward to maybe even if I could get back to like the 4 to 5. But no, you make a good point, and as guys, investment managers like yourself and myself, where we're trying to stay prescient and ahead and kind of like tuned in to where the economy is going and what's the right play, right? So a manager that really that delivers alpha to his investors is somebody that can see a little bit further into the future and kind of predict where things are going and figure out how to play off of that. There is something that's happened here, and this is, I think, what you were getting at with the COVID relocation, that is different than we've never seen this before. So you can look at the past as an indication of what the future might look like. It won't exactly ever look the same. It might rhyme, like you said. And there's a scenario with the decentralization, the need for people to no longer show up at an office, and the paradigm shift that's happened on a corporate, national, global level, that there is something to be said for the fact that you have a complete freedom to shift the population demographics in this country. That there will be a reset when we come out of this for the lower states. That there will be Texas and Florida, that while they may have to go through some sort of a cycle, and those guys that paid, that are paying, 50 million for a house on Palm Beach that was bought 2 years ago for 20. Those guys are going to lose a few bucks. There's going to be some cycles on the extreme ends of the market, but there is something to be said for the possibility that there's a complete shift that's gone on in certain residential or certain real estate markets in general. And Florida being the perfect example, actually. Florida has historically been a boom or bust state in terms of real estate. And I think now it's starting to mature. South Florida and Central Florida, for that matter, Orlando was really, when you look at it from a stability standpoint, Orlando was the one market that was the most stable the last 15 years because of the jobs that Orlando always continued to maintain. But you'll see a downturn. You'll see some stress in these new luxury condos in Miami. That's typical. But I also believe you've got a new level that you've set there. There is a new audience. There are hedge funds that have moved to Palm Beach. There is the New Yorkers that don't have to go back to the office that now live there, and that's true in other parts of the country as well. There is certainly a demographic shift that will have some bearing on real estate in specific areas of the country. That said, I also wouldn't throw the baby out with the bathwater when it comes to major metro. The easy thing to do is to read the headlines or follow the politicians who are saying everyone's leaving New York and it's a hellhole and blah 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 blah. And granted, when you walk through Times Square these days, you smell a lot of weed. It's definitely going through some phases right now.
You think that would calm the crime a little bit? You think they'd be a little calmer?
Yeah, you think they'd be like, hey man, everything's cool, bro. But I've been told, my friend told me that actually the cops don't even go into Washington Square Park right now. They sit on the outskirts of the park. And so that kind of thing is, that's a cycling thing. And, there's issues there. But for every wealthy person that is leaving their Upper West Side condo in Manhattan, which they're not selling, by the way, they're keeping, but they're moving to Florida or Vegas or Austin, Texas. And, for every one of those, there's like 2 or 3 college kids dying to move to New York City. The New York is and not just New York, by the way, like major metropolitan, Chicago, Detroit, even, Philly, DC, these markets, especially when you look at it on a global historical scale, our major metropolitan cities in the Northeast rival some of the greatest cities in the world. And even to this day, even with values where they are having kind of hit the top end of a cycle, it's still in line or even cheaper than London, Paris, Tokyo, Shanghai, Hong Kong. I mean, you've lived in these other cities and traveled around the world a lot. Comparative, it's still a great place to be. So I'm actually very big believer in New York. And I hope that it would settle off value-wise, but especially in Manhattan. But there is something to be said for the changing demographic brought on by COVID. And we don't know what that's going to look like long term.
Exactly. Yeah. One question that's come up a lot where it's kind of been debated is, what percentage of companies are going to force employees to come back, or really more of what percentage of workers will be allowed to be permanently remote compared to before.
Correct.
And I've talked to a number of business owners that there's really 2 separate salaries. If you're trying to recruit someone to New York, you have to pay 20, 30, 40% more. But if you're willing to let them work from, even sometimes suburban Pennsylvania, where they maybe come in 2 days a week, but don't have to get an apartment in the city,
right,
they'll take significantly less money. And that's going to really affect secondary and tertiary markets, I think, in a positive way.
We're already seeing that, by the way. We're already seeing that. I've got houses in suburban Pennsylvania, and I have exactly that kind of thing my brokers are telling me, because it's like the folks that, if they can now, instead of having to be in Jersey or Long Island, they can be 2.5 hours away, come in 1 day a week or a couple days a month, and now have a big spread and be in rural PA, and it's great, So that absolutely is happening. It will continue to happen. You're right. It'll be interesting to see. Listen, right now, corporations are doing whatever they can to get people. Apparently, I look back. I think I'm kind of reframing this the Great Vacation. Some folks have called it the Great Resignation too. That's the other term. But I think it's like the Great Vacation. There's this where I'm hearing the exact same thing you're hearing, Jack, which is a California firm wants to hire a controller for their real estate management operation. Well, in California, you got to pay that person $250,000-$300,000 a year. If they could search the nation and find just as quality a controller who could work remotely from Salt Lake City, Utah for $125. Why aren't they? And so corporations are jumping all over that out of necessity right now. The real question is going to be is if people start coming back to work, if there's a more availability of workers, then I think that, we'll see, we'll see. But I'm optimistic about the fact that corporations are going to find a way to mold to this whole hybrid model where, they'll have an office. Now, what does that do for the office real estate market? That's a whole other story. We're going to need another podcast for that one.
And neither of us are actual office guys, but we're both distressed real estate guys. So that's actually the point of I mean, if you had a defaulted loan on an office building at the right price, would you take a shot at something like that?
Absolutely. Yeah, absolutely. I mean, again, with now when you get into that though, it's really a location play. That's really going to be the, if I had to give one piece of advice to people that are looking to buy real estate or invest in real estate in the coming downturn, which we are on the precipice of, and it would be just to focus on a quality real estate. Now, you could buy a defunct vacant office building, and there's already talk about converting stuff like that to mixed use and residential. Now, so I would take a flyer. I have a couple friends that are in the office game, and the smart guys know that there's still plays there in real, it's on a case by case basis. Well, offices are not going to go away completely. What I'd be concerned about is in the office sector would be large buildings where large amounts of space are leased to one tenant, because where versus, let's say, a medical office with 25 different doctors' offices in it versus a health center, or like a one AT&T operations center, because those are the ones that you really have the risk, where the companies are not necessarily going to just give up offices, but the companies that have lots of office space are going to downsize. And it's much easier for a company that is 30,000 square feet on 3 floors to downsize to 10,000 feet or 20,000 feet, give up a floor, versus, a 5,000 square foot dental office. They're not going to, there's no real realignment that can happen there. So there are certain office that I would still believe in, but yeah, that's going to be a market to keep an eye on. There's going to be a lot of stress there.
Yeah, 100% agree. And I think, similar to sort of what happened in the residential market, some of the offices just need to be repriced. There's going to be groups that bought at a 5.5% cap rate 3-4 years ago that were 100% occupied, that are probably 50% occupied and maybe should be at a 10 cap rate now. So there's going to be some interesting opportunities for the right distressed loan buyers just to buy and restructure those deals.
Yeah, and I wouldn't even say that that's limited just to office. Certainly certain types of retail, big box retail that is like clothing brand oriented versus grocery. Grocery stayed strong, but big box retail on the the clothing, the Rosses, the TJ Maxx, the shopping malls, the indoors, old school shopping malls, those are all, I think, have to get repriced. And don't even get me started on when you talk about cap rates. I mean, I've thought that it was ridiculous where cap rates have gone these last years. It always made sense that a McDonald's at a 5 cap would, okay, that makes sense, or a 4 cap or something like that, but, when you see CVS's trading in the 4s, that based upon that rent, you're basically paying $15 million for an acre of real estate in a building that can only be used by 1 or 2 tenants in the country, and that's that just doesn't make sense. Never has, never will. Where it would be interesting to see is anybody who 1031'd out of, into a triple net deal, but then use leverage, because those guys are now, there's going to be a loss of equity in a lot of triple net cap rate deals, because it's just necessary that cap rates return to a more reasonable level, and that's what we're headed for.
Yeah, and I love the triple net for the complete hands-off passive approach, but many of them only have a few percent increase per year too. So if inflation is 7-8%, and if you follow shadow stats where they use what the 80s calculation for inflation was, it's 15%.
That's right. I love shadow stats. You
2% escalation, and inflation is 8 or 10%. So that alone, if inflation continues, should push cap rates to expand.
absolutely. I mean, you look at a lot of these grocery, not the groceries, the pharmacy deals were done with flat, 30-year flat deals or 20-year flat leases. And so there's people it's an interesting scenario that we're sitting in right now. You and I have been through a few cycles. We're moderately middle-aged guys, right? So we've been through the '08 cycle. And, I was a kid when RTC was around, but I had mentors of mine in real estate that told me about the RTC days. And many of my billionaire friends or multimillionaire friends made their money off like one deal in RTC, and it's an interesting place to be right now, to live through it now with a little bit of knowledge and and a little know-how and a little perspective on it. But
for our younger listeners, real quick, just like explain the RTC. I think that might be helpful.
Yeah, no, absolutely. So the RTC is what we would call the other major meltdown in real estate dislocation that happened in the 80s after the savings and loan crisis. So the S&Ls went belly up. The loans went bad. This was mostly in commercial real estate, where you had thousands of commercial loans on retail, multifamily, office buildings, industrial, whatever it was, all these S&L loans that when the S&L themselves went bad, the government took control of all of these loans in what they call the Resolution Trust Company. It's an organization that the government created to basically take these loans out of the hands of these failed S&Ls and distribute them to private investors all around the country. So it was the ultimate auction process. And you had, shopping centers in Hialeah that were netting $250,000 a year NOI, and they'd sell it a 10 cap back then. So that, and I know the guy, one of the guys that bought that, and he had, $2.5 million. He borrowed a couple $100,000. He happened to have some rich relatives. He borrowed a couple $100,000, got a loan from the bank. He bought this $2.5 million shopping center, 200,000 square feet in Hialeah, and immediately was cash flowing. The deals like that don't exist now. You don't buy 10 cap deals with upside potential right off the bat. By the way, he just turned down an $80 million offer on that center.
Wow. That's pretty,
there's an example of one guy, there's one property, one deal that existed that this one guy bought that, his entire family, his kids and his generation are, off that one deal. So the RTC days, which was the 80s when we were kids, that was the last time there was a major dislocation in financial and credit markets related to real estate, where the government had to step in and bail out the savings and loans, and then disperse these assets to private equity or to other banks. Then in 2000, and then the more recent thing is the residential mortgage meltdown, where banks and private institutions were motivated to give poor quality mortgage loans to unsuspecting buyers and borrowers that never should have qualified to begin with. I mean, I don't know. You remember the day, right? When those days. I mean, I remember like it's yesterday getting a loan on a $1 million waterfront house in Miami. And the borrower was a 20-year employee of Dade County, never made more than $38,000 a year. How did this woman get $1 million loan?
Yeah. Now, I've heard stories in New York City of the people that sell apples on the street buying a 3-family in Queens for close to $1 million.
Amazing.
And, it was crazy. Like, there was the joke, if you could fog a mirror, you could get a mortgage.
That's right.
Yeah.
So,
So what else do you do? You're primarily real estate, both on your, your commercial brokerage business and the distressed mortgage. What else do you do to diversify? Are you in stocks or crypto, or what other things do you dabble in?
I do diversify, but I'm the kind of guy that diversifies just to give myself heartache. Um, so, I would not take my advice in any area outside of real estate. I know residential real estate, like I've never lost money in residential real estate. I've done very well in commercial real estate in different aspects, either as a buyer or an advisor. And in stocks and in crypto, I got a little crypto. I bought some stuff here and there. Here's my take on crypto. I think that there has legs. I think that because we haven't had, when there's tailwinds in a market or in any economy, you're able to hide the con artists and the real failures, right? Bernie Madoff only became a household name and blew up because it happened in 2009 after people were losing their money in 2008 in other areas, and they come to collect on Bernie in 2009. If the market had continued going on, God knows how many other victims Bernie Madoff would have had if the market had continued upward. So we are right now at the precipice of a market that's really going to challenge other types of investment classes and investments in real estate as well, but certainly in equities, crypto, and all of these other alternatives. So, my thought, look, I have a little resentment towards crypto. The reason is I thought I was brilliant when in 2017 I bought Bitcoin for $450. And a year later, I sold it for $1,000. And I was like, man, I'm the most. And let's be honest, if I had just let it ride, we wouldn't be talking. Or no, we'd probably be talking as neighbors. I'd be with you in Puerto Rico.
Absolutely.
So it's funny because I was telling this to somebody the other day. There was this little piece of the Bitcoin when I sold out this package at $1,000. There was a 0.09% of a coin that I couldn't transfer into US dollars because it was like less than $1 or whatever. And I went into the Coinbase account just randomly about a month ago. The thing was worth $5,000. So it was like $5,000 of like free money that was worth 8 cents. So at least I got something out of but it makes you realize how much if I had left the $50,000 in, how much it would be worth. I mean, you can just do the numbers there. I'm in a couple other crypto things. My position is to find a few companies that I think have longevity and just buy in and not trade. I'm not a day trader. I'm not a day trader in equities. Every time I've tried to play that market, I've always been wrong. Maybe because I'm a little more contrarian. Maybe because I'm more of like a straight numbers guy. Like I look at stocks and I felt like they were overpriced for years. When you've got SoFi, a $50 billion valuation and their name on, the Super Bowl stadium, and they've never shown a profit, and they really haven't shown a way that they're going to show a profit. There's so many corporations in America. It's so similar to the .com era. There is so many corporations, tech companies, and other corporations here in America that have never made a profit. And their valuations have been driven by annual recurring revenue increases, but they've never found a way to build a profit. Everyone thinks the Amazon model will apply to them, and that's just not the case. So as the price of corporate debt increases, and you're going to start to see some of these, there's a lot of dead men walking in the equities markets, in my opinion. So like while some rosy-eyed equity investors, like the guys that I sat next to yesterday, would say, "Oh, prices are very cheap. It's a good buying time." That's probably true for the 10 or 20% of chops of stocks of companies that really actually create a revenue, have a history. I would even say the Amazons of the world. But even in, the older school companies that actually have revenue, those might be priced, those PE ratios are coming down to a realistic level. But there are still so many companies out there that shouldn't even exist. And the only way they've existed, even pre-pandemic, was the cheap money. And then during the pandemic, the even cheaper money that has been available, the fake money that we as taxpayers have written, the PPP checks to these corporations, and so that's my diversification. I own gold. Of course, I'm still a little bit of a doomsdayer.
Well, if you want to go doomsday, I listened to a 2.5-hour presentation by Peter Zeihan talking through Ukraine and this what may happen to commodity prices and kind of some level of deglobalization. And it's a bit scary.
Share that with me.
I absolutely will. It's it talks a lot about commodities and oil prices and really just what happens if global supply chains continue to be disrupted. So I'll send you that link.
Well, and we in America have never experienced what it's like the rest of the world always experiences. We go into the grocery stores and we got a little glimpse of this during COVID, but it wasn't long lived. And you start, maybe you see some remnants, but, you go into European grocery stores or Russian grocery stores or anywhere in the world, there's small things and the shelves are not always full. We just don't realize we've never lived outside of the perspective of a boom economy in America. Go ahead, we'll keep.
Yeah, that's I remember growing up, my parents came of age in the 70s and early 80s with the high interest rates and the recession, and they had wasn't quite a Great Depression mentality, but it was certainly right. A more grounded mentality than I came of age during the dot-com growth and graduated during the dot-com crisis. So this is 3 crises in already, and there's this perspective you only have from getting some scars that I know you and I have both lived through. So finishing up here, this has been amazing. Why don't you please tell the audience how they can get hold of you and what your I think you have a fund as well. I don't know if it's investors, but tell everyone how to get a hold of you and
sure. We are closing next week our first fund, which was all of our limited partnership funds at First Lien Capital are only open to accredited investors. But then again, there's 11 million of us here in America alone. So a lot of people that maybe wouldn't have otherwise had access can certainly look us up. FirstLienCapital.com, LIEN is how you spell First Lien. You can also find me. You can find me and my book and my history and my webinars all on my personal website, BillBymel.com, BILLBYMEL.com. And, I do a monthly webinar series. I think you've been a guest of mine, Jack. I try to bring in guys like ourselves who are on the front lines doing deals in real estate, either in the secondary market or retail, commercial, residential, mortgage, anything related to real estate. I have a book called Win-Win Revolution I wrote 5 years ago that really just is like a how-to / with anecdotal story of the last mortgage crisis and the paradigms that we created on how to manage distressed debt and deal with delinquent borrowers and, really treating people with dignity. That book's called Win-Win Revolution. You can find it on my website. You can find it on Amazon.com. And I am proud you'll be the first to place I'm saying this, I am in the works on a second edition, really retooled for the new economy and what's changed in the last 5 years in secondary markets. A lot of what will be in the second publishing of this book will be the similar basics of how you deal with mortgages in distress, but it's going to be a whole fresh perspective on where the markets have been the last 5 years. What's different in this secular downturn? I have a little bit of a different perspective on lawyers these days than I maybe had, 5 years ago. And so, I will be reprinting, or maybe they'll be coming out under a different title. Who knows? We'll see. That'll be in the days and in the months ahead. By the end of the year, that we should have a new printing of that. So
That's great. I just came back from a conference called Paper Source in Vegas. The night we didn't connect, like you were like
right.
two ships passing in the wind. And are you still actively selling loans from time to time to individual investors, or is it more institutional?
Well, we do have a loan. We had a loan trading desk for a number of years. We shut it down because we found that dealing with the private investor we needed to create a whole operation around it. And it was it wasn't worth the risk and the time that was involved. As we grow First Lien Capital, we will start to sell some of our product pre-REO. So, notes and reperforming loans. Much of that stuff is sold to institutional partners through our loan sale advisors. Yet we do maintain a private database. So if you're a buyer looking to inquire about individual assets, you can sign up with us at our website and reach out to us through our website and register to become a qualified buyer who gets the access to this product. Yes, that we'll see more and more of that as we acquire more in the coming year. I think we will then turn around and sell more. So that's what we're up to. We're always looking for good counterparties. We're always looking for client. We also do a third-party asset management for some of our institutional clients. There's a lot of people own loans out there that never really intended them to ever go bad. And so, and that's one of the unique things I've found, and it really, really amazes me, like private equity firms that you wouldn't even think were in the real estate game, that own these mortgage loans that they put on their books to clip a coupon, and now those loans have gone bad. And so there's going to be a lot of opportunity in the coming years, and we hope to not only be a part of that for our own success, but then to be able to share that with our investors and our other counterparties in the business.
That's great. Well, Bill, thank you so much for being on. This has been great. We could go 4 hours here, but I'm sure we'll have you on again as well. I look forward to getting together in the coming weeks or months somewhere as well. Come down and visit me in Puerto Rico.
Yeah, man, absolutely. I got to make that happen. Why aren't I doing that? We'll make a plan. I'm going to get down there.
Great. Well, thanks again. And everyone listening, please leave us a rating on iTunes, like us on YouTube, and look forward to seeing you on another episode. Thanks, everybody.
That's all for this episode of Alternative Investor Mastermind. Now that you know the many alternative opportunities out there, all up for the taking, you can finally become ultra connected and ultra wealthy. Get more valuable advice from the experts by subscribing to the show at alternativeinvestormastermind.com. Become a winner in the world of passive investing today in alternative investment strategies. Thank you for joining us. Until next time.